Hey guys, and welcome back to Wall Street Tactical. Today we will talk about PFE, which is Pfizer, a multinational biotechnology and pharmaceutical corporation. It's one of the following big things. Today we'll talk in detail about this company, so let's get started. Albert Bourla is the CEO and chairman. Pfizer works in immunology, cardiology, endocrinology, neurology, cancer, manufacturing medications, and vaccines. Due to its development of the corona vaccine in 2020, the United States accounted for 50% of the net performance, with Japan and China accounting for 8% and other nations accounting for 36%. When we say it's growing to be one of the giant corporations, we're not playing, as the numbers don't lie. Now that we've mentioned the numbers, it's time to take a look at them. We can get an idea of the growth of PFE by looking at its stable share price. Over the last 3 months, PFE has been less volatile than 75% of United States equities, averaging ±2% weekly movement. The weekly volatility of PFE is 2%, which has remained consistent over the last year. When we're talking about volatility, what do we mean? It's a statistical estimate of the dispersion of a market index or securities returns. A higher volatility means the riskier the security is. Let's now talk about the return versus industry aspect of PFE. Over the previous year, PFE outperformed the US pharmaceuticals industry, which returned 16.5%. For an engaged investor, a 16% return on investment is excellent. PFE is currently trading below the fair value of more than 20%. Investors are spending fair stock value compared to the company's revenue, as seen by the average of about 15 for PFE shares. The average following PE ratio for PFE indicates that the company has recently traded around the fair market value. Traders are always on the lookout for companies with good growth potential selling at a reasonable price. The PEG ratio is one popular statistic used to detect these stocks. The lower this ratio, the lower the cost of future profits growth. PFE has a price-to-earnings ratio of 19.8 over the last 12 months. Pfizer has a low valuation at its current share price despite tremendous growth due to an overpriced PEG ratio. The PEG and PE of PFE are lower than the market average, resulting in a lower than average valuation score. In 3 years, PFE's return on equity is expected to be high at 24%. It implies that a PFE is growing profit-generating while requiring less capital. It also shows that PFE's management makes excellent use of shareholder capital. PFE's earnings are of outstanding quality, and its current net profit margins are 22% better than the previous year's margin of 20.3%. We can attribute vaccine sales as one of the contributing factors in its fast growth. Indeed, PFE has risen by 11% over the recent trading days. The COVID-19 vaccine, which remains Pfizer's main growth engine, continues to perform well, and PFE's year-over-year profit increase of 65.5% outperforms the 5-year average. PFE's profit growth over the last year was 65.5% compared to 12.9% for the pharmaceutical market. Now let's talk about liabilities. PFE has $39.5 billion in short-term assets, and if we compare it to short-term liabilities, they are at $16.7 billion. So PFE has more short-term assets than short-term liabilities. And if you're unaware, the short-term liabilities ideally must be less than short-term assets. Over the last 5 years, PFE's debt-to-equity ratio has dropped from 70% to 55.6%, which is fantastic. The company's total debt is $39.84 billion, in which the long-term debt is $37.13 billion, whereas the current debt is $2.7 billion. The corporation has a net debt of $38.05 billion after accounting for $1.78 billion in revenue equivalents. But that's not an issue at all if we look at the debt coverage. At 41.3%, PFE's debt is well secured by operating cash flow, with a 14.7x range. PFE's debt interest payments are pretty well protected by EBIT. 3.42% of its dividend is greater than the lowest dividend in the American market. Those who don't know what a dividend, it's a payment made by a company to its stockholders. When a company makes a profit or has a surplus, it can distribute a portion of that earnings to shareholders in the form of dividends, and in the last 10 years, PFE's dividends per share have remained consistent. In the previous 10 years, PFE has grown its dividend payments, and as seen above, PFE is earning well, so earnings fund its dividend payments because of its reasonable payout ratio of 69.7%. PFE's dividends are expected to be recovered by profits in 3 years, with a payout ratio of 52.9%. When a company does well, who do we contribute its success to its management? If we look at the experienced management number, then with an average tenure of 2.6 years, PFE's management staff is deemed seasoned. A company is excellent until its team is excellent. A critical aspect of the management is the board, and after all, they run the company. PFE's board of directors is regarded as experienced, with an average term of 3.4 years. So, we see that the future looks prominent for PFE. There can be ups and downs, but that is the part of the stock market. Financial analysts are currently recommending Pfizer Incorporated stock, and since August, when it remained stable from a hold rating, this rating has remained unchanged. So guys, hope you've enjoyed the video. If you did, please subscribe to the channel and don't forget to hit the bell icon to stay updated.